Concerns about trade have been weighing on global markets as investors consider the potential economic impact on corporate earnings. Well, my next guest is here to challenge the narrative of that impact and what it could mean for markets. Brad Simpson is Chief Wealth Strategist at TD Wealth, and he joins me now. Nice to have you here.
It's great to be here.
Let's start with talking a bit about, the narrative that has been developing around trade. We hear about, of course, tariffs are going to be implemented on steel and aluminum, and we're hearing about more could be coming. And the impact on the markets, though, that is really what you're here to talk about. So tell me, what we mean, what people are talking about, and a bit about what we actually see happening.
I'd go as far as to say this is, in 34 years, this is one of the most remarkable times in my whole career. And I would say it comes down to, if you think about, especially if you took the period from February 1st to the 3rd, instead of Saturday to the Monday, when we were first talking about the first tariffs. And look, the long story short is, if I looked at those 3 days, the Saturday, I read about tariffs all day. Sunday, I had 2 conference calls. Read about it all day. Sunday morning or Monday morning, I got up at 3:45 in the morning. I did 3 conference calls about this. So it was about 3-4 hours in. I had 2 meetings. So it was before it was even 10 o'clock. I was 5 hours into talking tariffs. And the long story short is the middle of the market being open and looking at it and looking on FactSet and looking on my Bloomberg terminal and looking all the noise around it and then checking out and see what others were saying and all the hyperbole around it. And the reality is markets were very calm. And there was something missing. Like somehow in the middle of all this noise and what was going on in the market, and even like reading about what happened in the market that day afterwards and how it's been, the reality is markets have been very calm. And so I wanted to frame that. So I brought a chart along to try to look at it, right? So the one on the left is basically what it is. I took February 1st and looked at the change of the market during the day. So really there was a high-low movement of the S&P 500 between 75, down 75 to 100 to 150 basis points. And all in all, if you kind of look at the market going back to 2000 and think of how many things have happened since 2000 in the markets, right? Markets have traded like they did on February 1st, 10% of the time. Meaning that this was not an extraordinary day in any way. It was hectic, but it was an ordinary day in markets. The one on the right, what I'm showing is going back and looking at when the first tariffs were implemented between the United States and China in 2018. And markets were moving from 0 to down 4% for about 3 months there. That's high volatility, right? And what I wanted to frame with this is to say that every year we have our national conference and our research conference, which is on January 20th, and I put this slide up on the screen and I said, is the pricing mechanism of the market broken, right? And so when non-finance guys speak, right, like we say that going out 6 to 12 months is the market's pricing what you think is going to happen. And when I'm saying, was it broken, I was saying that who doesn't know that there's going to be tariffs, right? And the reality is that the market knows this. And so what's happened from 2018 to now is that the market's become less extreme. The noise around it has become more extreme. And there's an amazing dichotomy in that. I think that to continue to be able to frame this way is just to understand that really the pricing mechanism of the market's working very well. I think that for investors, the best thing to do is to start with is that almost everybody's become an expert in tariffs now.
Yeah, in the same way it happened with COVID, the same way it happened with everything before it. Yeah.
And my suggestion is to start out let's just use as a base case. There's going to be tariffs. Full stop. And if we use that as a base case, then it gives you a lot of understanding is that every time you hear a different thing happen, a different change, is to go, well, no, wait a minute. I was expecting this to happen. And so was the market. And then that really turns the volume down and it gets it back to really what our job is to do. And our job is to manage capital and allocate capital and grow and protect it. And the reality is there's lots of good things going on in the economy where we can do that.
Yeah, I was going to say that it's fascinating to hear that too, because when you think about the advent of social media, everything is amplified, right? And everything, and so to see some facts to show that that's actually not the case in the markets is calming. So thank you, but that's actually nice to see. Let's talk a bit about the bottom line is when we want to go. From an asset allocation standpoint, maybe let's talk about what you think about in terms of the different assets. So I don't know if we want to start with fixed income, and you can tell us, what you're thinking along that front.
Sure. Well, let's even for that, if we took a step to go, how are we going to make those decisions,
okay.
right? And so our starting point is that ultimately when you're making decisions, is you have to determine where you think the economy is going to go. Now, because if you look over the long term, if you go over 15 years, like what makes investment works is over 15 years, it's almost impossible to lose money. And the reason for that is there's usually a couple economic cycles during that time. And so for the starting point for us is to say, if we can figure out where we are in the economy, if you can come to terms with first and say that there will be tariffs, and then the second one you go, I'm going to determine what's happening in the major industrialized nations, the ones with all the skin in the game. So what's happening in Canada? What's happening in the United States? What's happening in the Eurozone? What's happening in China? And if you look at it in those terms and say, if I can frame that, and so we actually come up with just one consistent framing to say, let's look at employment, let's look at manufacturing, let's look at what the service economy is doing. Let's look at what
taxation,
and then let's look at monetary policy, and how much liquidity or what interest rate levels are. And if we're looking at that consistently, and we're looking how that's changing and how that's evolving in a world where we know that there is this ongoing change in a tariff, we can start having a pretty good range, right, in each of those major trading nations. And really, those are the nations that make the world's market go around, the world's economy go around. And if you can do that, and for us, and that's our approach to doing things. I think if you do that, then you start to come into the conclusions how you're going to allocate. And again, if you think about it, everything I'm saying here is coming down to, I want to cut out the noise.
Right.
Right? I always say that it's not what you think, it's how you think. And for us, we're just consistently going and coming back and looking at things in a consistent way so we can take that noise out and allocate it.
When we think about asset allocation, maybe take us through the different asset classes and what you're thinking. Fixed income right now as a modest underweight. Why?
Yeah, well, when you're looking at a concern that there could be an escalation of inflation again, just a concern, not making a call there. Then really what you're doing is you're investing for the coupon, for the interest rate return. We think there's going to be a lot of interest rate volatility, so there's maybe some opportunity for capital gain, but for the most part, clip the coupon on your fixed income. It's a good coupon, and still makes an awful lot of sense.
Let's get into equities, because I know you have a little bit more behind here, and I think, and correct me, it's modest overweight on equities.
Right.
Take us through your thinking.
Yeah, and I think I know I brought a chart along for this, and it kind of hits at home at this, is that I think we all know that how much over the last few years that returns in equity markets were derived by technology. And so when we look at the economy today, we make this pronouncement and we say, we're not talking about a soft landing anymore. If anything, we're not even talking about an early stage economy. This economy has been moving so fast, we have an economy that we think is mid-stage. And so if it's a mid-stage economy, which we think it is, we think it's a healthy one. And in an environment like this, what we're showing on the left here is saying that cap weighted versus the equal weighted. The equal weight is those other 493 names. And lo and behold, we think there's lots of opportunity there. 14 to 16% earnings growth expectations across sectors, and a very, very healthy mid-stage economy, typically when an equal weight index does quite well. The right, what we're looking at is showing manufacturing picking up. As manufacturing is picking up, what tends to do well is small and mid-cap companies tend to do well in an environment like that. And what we're showing on the last one is looking at there so much so, saying that if we look at the earnings expectation of small cap companies and mid-cap companies, they're actually much higher than our expectations for large caps, which is the complete opposite of what we saw, in 2022 and 23 and 24. And so with that, we think that the fears and concerns around concentrated equity markets, they're understandable. The reality is this is a market that's really broadening out, and we think it presents an awful lot of opportunity for investors. You have another chart here I want to bring up too, and tell me a bit about this one from an equity standpoint, why this is material. Yeah, it's actually twofold. What we're looking at here is we're looking at the correlation between equities and stocks, right? So how are they moving together? When you build a diversified
equities and fixed income.
Excuse me. Yeah. So long story short is you want your fixed income and equities to move in opposite directions. What we're showing here is that they're increasingly moving in the same direction, and so as a diversifier, they're not as reliable as they used to be. And so for us is to say is really what our notion here is that we are a asset allocation team that believes an awful lot in building portfolios with different diversifiers. And so what we're trying to say is this is an environment where if you're concerned about fixed income not being as good of a diversifier, which this is showing that, you want to get that from other areas. Yeah. You want to hedge. You want to use long, short, and market neutral strategies. And in an environment, if you look at the equity environment right now, what I'm showing you is as more and more names are moving out, that creates more and more opportunities for you to go long some of those names, short some of the others. That's a very good diversifier. This is, and I would say like where we are with concerns about volatility in the marketplace, very much a changing economic environment, this is a very good strategy and way to build a better diversify. And an active strategy to be very clear. And so this also shows that active management, even long only, is a good environment for that. I've only got about a minute here, and I apologize, because alternatives, you have a modest overweight, commodities, modest underweight, and I'm just thinking, again, this is when you think about the diversification as well, too, totally. Right? So one, we like infrastructure. I think we have an awful lot of build out in infrastructure. I mean, if you look at anything going on in the world, you'll see that's your core plus, right? Your data centers for sure, but even like your electricity grid, utilities, all those pieces. And so we like that an awful lot. And commodities, I mean, if you look at the uncertainty that we had in December, where both fixed income and equity markets were under a little bit of pressure, commodities were up. And in an uncertain geopolitical environment, commodities are an excellent diversifier in portfolios. And with the super cycle that we like as well, we think we continue to like those in portfolios as well. 15 seconds. I'm looking at the note that I know you're about to put out. So I'm going to say you have here how to not get lost. Right. Tell me a bit about that. Well, I think it comes really full circle for us is that, and as we talked about, in this world of such extreme opinions and such extreme positions, that I think it's imperative that you have a process for how you think, that you have a diversified portfolio, but a diversified portfolio that I think it goes well beyond just owning stocks and bonds, making sure that if you're using hedging strategies, using things like private equity and private debt, private credit, investments like that, be consistent with it, try to keep out a lot of that noise. This is a much better environment than what you think.